Okay.
All right. Okay. Welcome everyone to Bamboo Wealth Financial Planning Matters. We have a special guest today, Sue Herrald. Today we'll be discussing investment bonds as an alternative. Now, Sue Herrald has been in the financial service industry, I think, over 25 years. I'll let Sue clarify that. But I have known Sue for a very long time and has predominantly worked in the investment bond world under IOOF. So she has many years' experience in investment bonds. So we're quite privileged to have Sue here with us today to answer some questions. And so I wanted to allow Sue to introduce herself. Sue, thanks very much for being with us today on that Financial Planning Does Matters YouTube. Just like to, if you can introduce yourself to the audience and you know, how long you've been in the industry and currently what you do and who you're working for.
Thank you, Sam. Yes, and thank you for inviting me along to do this session. Really, I think we'll make it more educational about investment bonds. As you said, I've been in the industry for a very long time, and I was really specialising in investment bonds when I was practicing as an advisor, and I could see that the industry had long forgotten about them. So I think we've firmly put them back on the table as just an alternative tax structure to superannuation.
Okay, wonderful. Thanks, Sue. Now, bonds, as you mentioned, have been around for a number of years. So what has happened recently to bring them back into the financial planners' limelight or focus?
Okay, I think with superannuation, we know that is the most tax effective structure there is, but sometimes we see that perhaps clients actually can't get their money into that structure simply because they may have already maximised their concessional and non-concessional contributions. They also may be too young. I mean, you know, you need to meet a condition of release to get your money out of super, and they also may be too old, so they may not meet work test rules, etc. So investment bonds simply became the structure that could fill that need for an alternative tax structure.
Okay. Now, investment bonds are like managed funds, and they're just like any other type of product in terms of you can invest in a self-managed super fund, as you know, companies, a trust, whether it's family trust. Now, what makes investment bond a unique investment structure in terms of the options they provide clients?
Okay, so an investment bond literally is just a tax structure, as is super. Major difference being that an investment bond is issued out of the Life Act, so there always has to be a natural person as the life insured. So there are really three segments that there can be. There's always an investor, which can be a company, a trust, or individual, and that can be up to 3 individuals. There always has to be that natural person as the life insured. And then, of course, we can append beneficiaries if we need to. So from an estate planning point of view, there are some very strategic situations where an investment bond can fulfill the need of isolating funds away from an estate and making, I guess, funds go to where they need to go quickly and efficiently. But the structure is you know, just a tax structure that sits over the top of the underlying managed funds, just like you would find in a super tax structure or a platform.
That's correct. So as an investment options, how do they compare to superannuation? I understand they're both superannuation and managed funds as tax structures. One is taxed at 15 cents accumulation, the other one's taxed at 30 cents in accumulation. How do they compare from your experience in the conversations you're having with people today?
Okay, with the platforms and superannuation being such a large industry or large investment portal, the investment menus aren't as large as super, but we think that all asset classes are covered. So in our investment bond, there are 16 investment options, and that ranges from cash right through to international shares or a mixture thereof through multi-manager funds. So all of the asset classes are covered.
Okay, excellent. Now, we are living in interesting times. Today, we have the lowest interest rates in probably over 50 to 60 years. So they are quite extraordinary and also opportunistic. So how can investors take advantage of investment bond in this current environment?
Look, I think An investment bond is all about deciding whether or not you want to invest your money. So, I think leaving your money sitting in the bank, especially in a low interest rate environment, is not invested. Of course, that's where any short-term funds should be, depending on your time horizons, is really what you expose your money to. So, a couple of things where if you're wanting to invest your money and you do need an alternative tax structure or a structure that caps your tax at the notional rate of 30%. And I say notional because the underlying funds do receive franking credits, etc., which are passed on to the investor. So it's a matter of, okay, looking at the risk profile and then saying, okay, we can invest in managed funds that will give you the opportunity to outperform cash.
Okay, no worries. And just one other thing. Now, investment bonds have been around for a while and haven't been used a lot for probably, from my memory, probably 15 to 20 years since the credit boom that we've experienced. What is one myth that you currently or commonly come across in the market with investors or even financial advisors?
I'm sorry, Sam, I didn't get that question properly.
What is one current myth that you hear about investment bonds?
Oh, okay. I'm terribly sorry. Look, they've always, and I guess in the past, been thought of as 10-year investments, that people just assumed their monies had to be invested for 10 years. 10 years is simply a line in the sand, which becomes an extra tax advantage. So if you've been investing for 10 years, and that means including adding to your investment bond, so you may have only been adding funds in the last 12 months. Once you've passed that 10 years from the date of your initial investment, you will never ever have any further personal tax liability on any growth and earnings when you withdraw funds. The same is achieved when the life insured passes away. So if the life insured passes away, then those funds also become tax-free back to the investor, or if there are no nominated beneficiaries on there. If there are nominated beneficiaries on there, they will go tax-free there first.
Okay. And so you've touched on a few points there in terms of reasons why people invest in investment bonds. So what are some of the most common uses for investment bonds from your experience?
I think the simplest way to position them, Sam, is to just say, if you're too young to put money into super and you're looking for an alternative tax structure, then an investment bond can simply pursue that for you. If you're too old for super, it is not generally about tax. It is generally about estate planning, because in this day and age with our tax structures, you can certainly earn quite a lot of money before you have to pay tax. So if you're too old to put your money into super and you need the structure of an investment bond, it is generally about estate planning.
Okay. So that leads to my last question, which is estate planning. As financial planners, I'm always looking at estate planning because we have such complex lifestyles and also blended families. And what would be one common uses or practical applications of a bond when it comes to estate planning?
Okay. Look, the simplest thing is knowing that by having beneficiaries on your investment bond, that the funds will simply pass to those beneficiaries, so outside of the estate. So as I said, isolating them away from the estate, it means that you don't, you're not worrying about the time and the cost and the delays of getting the funds to where you actually want them to go to quickly and efficiently.
Yeah, okay. And that's a big benefit because, as you mentioned before, if it goes to a beneficiary, there are tax benefits being tax-free, which is quite important. And you also avoid costly and stressful costs in relation to dealing with going to courts or arranging probates unnecessarily. So you do stream your process to the remaining family members who may need the money immediately. Okay, Sue, anything that you'd like to add before we finish?
Look, I think, Sam, it's just about, looking at the differentials. As I said, we all have super. We all know what that structure is. It is just the non-super tax structure. So if super is not an option, the basic fundamental differences, super, as you said, is notionally taxed at 15% on earnings in accumulation phase. Investment bond is notionally taxed at 30%. The major thing is with super, and I guess, and this is where they have become quite popular again because of legislation legislative risk involved with super,
Sure.
is that you don't need to meet a condition of release. And the other thing that that an investment bond can do that super can't do is, with our investment bond, you actually have the ability to use it as security for borrowing against.
That's
So
correct.
if
Yeah.
you've got money in super, we know that
Yeah.
you can't borrow against that or use that as security, but an investment bond you certainly can, or our investment bond you
Sure.
certainly can.
Yeah, you've touched on some very important points there, and some uses of investment bonds. Particularly, I'm familiar with the IOOF products. I've used it for a number of years. You're referring to the loan back facility. In relation to providing advice, so today's discussion is very general in nature. It's factual information. It's not designed to give anyone out there advice. So, guys, if you need advice, please see your financial planner or come and see us. But essentially, investment bonds do have a lot of applications. You've touched on a few of them there. Taxation was one, estate planning, and also investment options, and also, you know, in relation to borrowing. So these are all complex areas that you need to have very specific discussions with your financial planner. But once again, Sue, thank you very much for being with us today. We appreciate your time, and we look forward to hopefully talking to you more about these in the future. And thanks once again, and we look forward to speaking to you again. Thank you, Sue.
All right. Thank you, Sam.
Right,
It's
yeah.
been a pleasure.